This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everyone. Live on Bloomberg TV, radio, YouTube, and Bloomberg Originals. It is Bloomberg Businessweek Daily. I'm Tim Stenovec, along with Emily Graffeo. She's Bloomberg News cross-asset reporter. She is in for Carol Massar on this, yes, Fed Wednesday, August 20th, 2025. Those minutes from the Federal Reserve, the last FOMC meeting, expected to drop in the next 10 seconds. We are going to bring you those headlines as soon as we get them. In the meantime, the S&P 500 down 0.4%. The NASDAQ composite down 0.9%. Stocks off their worst levels of the day, but yes, tech down once again. Those minutes crossing as we speak. The majority of Fed members saw inflation risk outweighing the employment risk. That is the red sticky crossing the Bloomberg terminal. The minutes of the Federal Reserve, July 29th to 30th, crossing just now. Many noted the full effect of tariffs could take some time. In addition to that, several members of the FOMC flagged the risk of inflation expectations unanchoring, and several expected companies would pass tariffs to consumers. Several also noted concerns about elevated asset valuations. Several members said current rate may not be far above neutral. Once again, these are the minutes released of the July 29th through 30th meeting in Washington, D.C. I want to bring in Stuart Paul right now. He's U.S. economist for Bloomberg Economics. He joins us here in the Bloomberg Businessweek studio. Stuart, a lot has happened since this meeting actually took place. The non-farm payrolls report that came out as a shock, a weaker ISM manufacturing reading, a surge in producer prices. We'll talk about those in a second. Your immediate reaction to what just crossed, though?
Incrementally more hawkish than what we saw in June. What we're really thinking about when we look at these minutes is whether more or fewer than most committee members feared persistent tariff-induced inflation, and whether more or fewer than many committee members expected a gradual softening of labor market conditions. As you pointed out, the majority saw inflation risks outweighing employment risk. And at the time of the meeting, that likely was the case. But these minutes were just a bit stale, even just 2 days after the FOMC.
That's when that shocking non-farm payrolls report came out.
That's exactly right.
With prior revisions, too.
That's exactly right. And so the fact that at the time that the FOMC met to make that interest rate decision, and as these minutes were being written, that most, or the majority, interchangeable words here, saw inflation risk outweighing unemployment risk, that's likely shifting right now. And so as we read through these minutes just a little bit more, the thing that we want to keep in mind and the thing that we want to look for is just how thin the majority was and how loosely held was that view of the majority. How easily will they be swayed to thinking that at the current moment, with the revisions that we have now, employment risks are outweighing inflation risk?
If we take a look at the bond market right now, we're not seeing a ton of movement in the front end of the curve. The 2 years down about 1 basis point. If you do look, though, at the WIRP page on the Bloomberg terminal, the model estimates about an 84% chance of a cut by that September meeting. Knowing what you know now about the minutes and, of course, the data that we've seen in between then, does that seem about right, 84% chance of a cut?
It does seem about right. It almost seems like the conversation should be moving to whether the risk is that there will be no cut in September or a 50 basis point cut in September. I think that right now risk is probably skewed towards 0 cuts. From, right now, obviously, consensus view is that there's going to be 1 25 basis point cut. Risk is probably skewed to the downside. The thing that probably matters from these minutes is that going into the Friday jobs report that changed our view of the labor market, FOMC members, the voting members of the Monetary Policy Committee here, were more so focused on inflation risk. And with tariffs incrementally rising, they're going to be even more focused on inflation. And I think that that's something that they're going to need to weigh against the renewed or altered view of the labor market.
It brings me to another headline, Stuart. Several of the members expected companies would pass tariffs to consumers. Is that surprising? Is that news at all to you? I mean, I think that's kind of been the expectation.
That is.
But the PPI print that came in showed that a lot of companies were absorbing this.
That's right. So companies are absorbing this. The line that I'm focused a little bit more on right now is several officials are concerned about slower real income growth. Like, that's a little bit of a tip of the hat that the majority that did vote to hold rates steady could have been getting a little bit nervous about the labor market even as they decided to hold rates steady. The fact that several members are focused on slowing consumer income growth means that firms are going to have relatively less capacity, less space to pass on higher costs to customers. If folks' incomes are slowing, if the labor market is cooling, then yeah, firms are going to feel their margins getting squeezed. They're not going to be entirely able to pass along those higher input costs.
Yeah, but seeing another had several flagged risk of inflation expectations unanchoring. As you suggested, that wouldn't be good for the trajectory. Another headline here, several noted concerns about elevated asset valuations. We don't, sometimes kind of how the Fed thinks about markets gets a bit lost in the mix when we're talking so much about labor and inflation. Well, what do you make of that comment? Are they watching? Are they paying attention to the rise that we've seen in the stock market, the rally since Liberation Day? Almost certainly. And this is what's a little bit tricky when we go through the minutes and we start trying to use quantifying words like many or most or several. We sort of lose track of the fact that there are at least a couple different camps within the FOMC, one of which is more academic, led by folks like John Williams, who will take their estimate of the neutral rate of interest and look at where we are with the federal funds rate target range and say, policy is restrictive relative to our academic estimate of neutral. Then you have more markets-oriented folks like Alberto Musalem or Lori Logan or Beth Hammock, who will look at where asset prices are and say, it's really difficult for you to tell me that rates are restrictive right now. So when we focus in on some of these quantifying words, we lose a little bit of track of that. And I think that, Emily, as you just pointed out, if you have folks out there who are worried about asset valuations or markets that are a little bit frothy, they might be a little bit more so inclined to move very slowly once they resume cutting rates. And that's why we expect that there will likely only be one rate cut this year.
Stuart, we're about to head to Jackson and talk with Michael McKee, Bloomberg News International Economics and Policy correspondent, who's there, of course, for the Economic Symposium. We'll hear from Jay Powell on Friday. What does all of this that we're reading right now, the minutes, but also the data that we've gotten since then mean for Powell's speech on Friday and what he intends to communicate?
Powell's going to have a few different priorities, one of which is going to be discussing the monetary policy framework review, where he's likely going to move away from the current flexible average inflation target. Again, it's a little bit more of an academic exercise with a little bit less relevance to what we're thinking about with September. As we read through the minutes and as we think about the data that we've seen, everything basically points to an incremental move toward monetary policy getting a little bit less restrictive and a little bit of additional comfort in the balance of risk shifting towards cooling employment. And I think that Powell is going to need to acknowledge that when he speaks just later this week in Jackson Hole.
Stuart Paul, U.S. and Canada economist for Bloomberg Economics, joining us here in the Bloomberg Businessweek studio. I want to bring in Michael McKee, he's international economics and policy correspondent for Bloomberg TV and radio. He joins us from Jackson, Wyoming, where he's gearing up for the Jackson Hole Economic Symposium. It officially starts tomorrow. Mike, though, getting a lay of the land. Mike, I want to bring you in just on the latest that we heard from Stuart and from the Federal Reserve with regards to these minutes. The Treasury two-year yield pairs its decline after the FOMC minutes came out. The majority saw inflation risk outweighing employment risk. Several members flagged the risk of inflation expectations unanchoring. Several said current rate may not be far above neutral, and several expected companies would pass tariffs to consumers. What is your instant reaction to these minutes?
Well, it was very interesting because what we had seen is a fairly strong employment report for June in July. And then we got the CPI and PPI numbers that were more worrisome in terms of inflation going up. And the Fed met at the end of July. So they were already looking under the hood and seeing some issues with inflation growing. And that sort of mitigates, as Stuart said, against perhaps a cut in September if we get the same kind of numbers again. The question is, what are we going to get? Are we going to see more inflation? And if that's the case, the minutes offer support for the idea that the majority on the Fed isn't going to move if we get a weak employment report, unless it's very weak.
Mike, when you look at some of these heads, and I know we still have to kind of parse through where tariffs come up in the minutes. Many noted the full effect of tariffs could take some time. What's your understanding right now of just what that length of time means? What do most Fed economists think about just kind of how long it takes for us to really see the pass-through effects of tariffs?
In general, they were looking for about 6 months, say the end of the third quarter, the beginning of the fourth quarter this year. But it's been complicated by the fact that the Trump administration has been on and off about the tariffs. First they put them on, then they pause them, then they bring them back, and now some more have gone on, and there are more to come. So this could stretch out over a period of time. And the other thing is a lot of companies brought in imports from overseas early to try to build their inventories so they could sell things to people without raising prices. Those inventories are getting run down, and prices are going to have to start going up. We've seen in earnings reports some companies, Home Depot yesterday, saying they were going to have to start raising prices. So we should start seeing it as the months go on. But the question is, does it happen all at once, or does it happen over months and months and months and take away people's belief that inflation is anchored? We saw Friday the University of Michigan numbers suggest that people are getting a little worried about inflation.
All of this going to be top of mind for policymakers and officials gathering in Jackson for the Jackson Hole Economic Symposium. Officially kicks off tomorrow, as I mentioned. So, too, I think, will be among the things people talk about is what's happening with allegations that the president is leveling and others in the administration are leveling against members of the Federal Reserve. This time, Bill Pulte at it again. It's a most read story on the Bloomberg. It's about the director of the Federal Housing Finance Agency urging AG Pam Bondi to investigate Federal Reserve Governor Lisa Cook over a pair of mortgages. President Trump posted our Bloomberg News story to social media and said Cook, quote, must resign now. Mike, is this all about remaking the Fed?
Partly about remaking the Fed and partly about the efforts the Trump administration has had to weaponize the government against Democrats. The thing about the Fed aspect of it is Lisa Cook is not a decisive policymaker. She's not a swing vote. She'll generally vote with the majority, generally vote with the chair in terms of leaving interest rates unchanged in recent months. Removing her wouldn't make a big difference in the president's goal of driving down interest rates, but it would give him the opportunity to name another person to the Fed. And they could name somebody who is much more sympathetic to low interest rates. And that's going to have people's backs up. A lot of economists already reacting negatively to this news. But we don't know what the bottom line is in terms of what Lisa Cook may or may not have done, and the Fed doesn't know. And so at this point, I wouldn't expect Cook or the Fed to comment on it. And we're going to have to see where the Attorney General takes this, if she takes it at all.
Mike, you're not a politics reporter, but you were for many years. So I think it's fair to ask about this pattern of alleged wrongdoing that seems to be coming from the Trump administration, pursuing mortgage fraud allegations against other high-profile Democrats. California Senator Adam Schiff, New York Attorney General Letitia James. There's also the alleged impropriety that you've covered a lot at the Fed with Powell in regard to the remodel. How do you look at that?
Well, I think a lot of it is basically just an attempt to influence public opinion. You throw the charges out there, and the public remembers that because they get big headlines. And then if somebody is cleared, or if the Attorney General and the Justice Department don't even take up the case, you don't hear much about that. And the idea is to build some skepticism in about these various people so that when they take on the Trump administration or they do something the administration doesn't like voting to keep interest rates steady, the president can blame them instead of himself or his own policies.
We want to get to Jackson Hole because I can at least say I'm very envious of the background that you're sitting in front of right now. It looks beautiful. Can you talk about the tone, the mood? How much of the discussions at this meeting are actually going to be about Fed independence and who the next chair is? There's been so much talk, at least headlines, about Trump weighing in on who his pick is going to be, who's going to be the next pick. Is that really going to take up a lot of the conversations, or is it going to be more an economic symposium?
Well, I suspect it'll be dinner party conversation. Well, it's not parties, but dinner conversations and maybe on the sidelines. But the official subject here is labor markets in transition, which is a very timely topic given the fact that the labor market seems to be in transition, at least with the July jobs report. The only thing is these are academic papers looking forward into the future, and they don't have a lot of bearing on what is going to be happening in terms of policy in the near term. So I think it's going to be a bifurcated session where people are talking on the sidelines about what's going to happen next at the Fed, but the main program is going to be about what could happen down the road 6 months, a year or so from now.
Talk a little bit more about labor, this topic here, because it was interesting in the minutes, and although these are backdated, that the Fed officials seem to be more concerned about inflation, and they're saying that outweighs concerns over the labor market. But what's the, I guess, tone going to be on that Powell speech on Friday about the labor market?
Well, I would imagine that he's going to say we need more information. The Fed looks at the unemployment rate as sort of a proxy for U.S. growth. And in this case, the unemployment rate really hasn't moved. We saw weak hiring, but not a lot of firing. And so the Fed is probably going to be looking to see what happens with the August payrolls report and if anything bleeds over into the unemployment rate. That's maybe the point that Powell would make in a perhaps less direct way. The papers that are going to be presented here and the talk that we're going to have here is going to be more about things like what's AI going to do to the workforce in the future, and what's happening with the retirement of the baby boomers and the inability we've seen so far of recent college graduates to get jobs. So it's more about the structure of the labor market than about what's happening because of tariffs or fiscal policy.
Yeah, you add immigration to that mix, something we've spoken quite a bit about, Mike, this week when it comes to how that changes and potentially changes the labor picture moving forward. Hey, before we let you go, one more on the next potential Fed chair, David Zervis over at Jefferies, formerly of the Fed. That's where he began his career. Then he went to Wall Street. He was on CNBC earlier today. He said, the Fed has never been independent. The political pressures on the Fed have always been growing and continue to grow. He highlighted pressure from Democratic lawmakers in recent years on monetary policymakers to lower interest rates. Is the Fed independent?
The Fed is independent, at least in terms of the way it acts. Republicans are pulling out or trying to make coincidences into causation. The fact that the Fed lowered interest rates in the past was not because they were trying to necessarily help a politician, but because the economy called for it. Remember, last summer, we saw the unemployment rate rise significantly, and that's just before the Fed cut rates 50 basis points, which is why they did that. That was the reason they cited it. It makes sense. It wasn't an attempt to help Joe Biden, but because the two things happened at once, people like David Zervis are trying to make the case that the Fed is biased. But the Fed is not biased. They are biased only towards what the economy is telling them to do. You can argue about whether it's the right move to raise or lower interest rates at this point for what will happen down the road, but it's not a political decision. We are biased towards Michael McKee here on Bloomberg TV and radio. That's Michael McKee's Bloomberg News international economics and policy correspondent joining us from Jackson, Wyoming. Stay tuned to Bloomberg for continuing live coverage from Jackson Hole through the rest of the week. Mike McKee and company are on the ground in Wyoming to cover the Kansas City Fed's annual economic policy symposium. We've got a great programming Thursday and Friday coming up there. Coming up next, we're talking venture capital on Bloomberg Businessweek Daily.
Nasdaq all declining, with the S&P 500 index down 39 right now, drop there of 0.6%. It is a Fed Wednesday. We got the minutes 20 minutes ago. Most Federal Reserve officials highlighted the risk to inflation as outweighing concerns over the labor market. At their meeting last month, as tariffs fueled a growing divide within the central bank's rate-setting committee. S&P, as I mentioned, lower now by 0.6%. We do have the Dow down 106, drop there of 0.2%, while Nasdaq lower by by 258 for the NASDAQ Composite Index, a drop now of 1.2%. Our Mag 7 Index is tumbling by 1.6%. The 10-year, 4.28%, with the 2-year right now, 3.73%. Spot gold is up $28 the ounce, up 0.9%, while West Texas Intermediate crude up 1.5%, 63.27 for a barrel of WTI. Microsoft has curtailed Chinese companies' access to advanced notifications about cybersecurity vulnerabilities in its technology after investigating whether a leak led to a series of hacks exploiting flaws in its SharePoint software. Microsoft shares, they are trading lower now, down 0.9%. And Guess will be taken private by Authentic Brands Group in partnership with its co-founders. Shares of the retailer are surging now by 25.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for the update, Charlie. Do appreciate it. I want to talk fintech, financial technology. Chime Financial, it's a prominent fintech, recently IPO'd. The stock actually fell below its IPO price of $27 for the first time. 69 days after going public, this is traders dumped shares of fintech companies during a sell-off in U.S. equities over the last couple of days, today included. We see SoFi, Block, Affirm selling off yesterday and today as declines in big tech stocks push major indexes lower. I want to bring in David Haber. He watches this stuff closely. He's general partner at the VC firm Andreessen Horowitz. It's perhaps among the most well-known in the world, having made early bets on Airbnb, Coinbase, Facebook, when it was called Facebook, Instagram, Figma, Lyft, Slack, Affirm, Skype, and more than 700 other companies. Also joining us, someone else who watches fintechs closely, Paige Smith. She's consumer finance reporter for Bloomberg News. Everybody is here in the Bloomberg Businessweek studio. David, I want to start with you. The fintechs I mentioned, Chime, SoFi, Block, Affirm, one of which Andreessen Horowitz has invested in. Yep. How do you think about these in the context of where we are in fintech? Is this like a sort of Web 1.0 in where we are with fintech?
It's a great question. I think we were chatting about, Paige and I were chatting about this earlier. I think a lot of fintech from, call it 2012 to 2018 were these style of companies. These were businesses that lead with a financial product. And they got started by really unbundling the bank, kind of building a wedge, whether it's a trading product or a fee-free mobile-first bank account in Chime's case. And as they've scaled, they've kind of rebundled product to try to become the primary sort of financial relationship with their end customer. I think where I've been spending time, and I used to run a lending business, which wasn't a direct competitor with these, but was a very challenging, company to lead, has been different, right? The types of fintech companies that I look for and most like investing in are those that lead with software or have the potential for a network effect, right? So often selling into large financial institutions as opposed to trying to compete with them directly. And it's been one of the things that I've been spending time the last 4 years here at Andreessen is just trying to bridge the gap between what's happening on the frontier in the startup ecosystem and many of these large financial institutions.
David, I have a question for you as well about one of the companies that we chatted about, which is Plaid, and kind of this interesting dynamic right now around charging. There were theoretically, negotiations are ongoing, discussions are ongoing, and the regulatory environment is a little bit uncertain right now. But sure, the idea of charging for access to customer financial data, it was kind of an issue that was settled for a hot minute and has now sort of come back. I guess I would be curious about from your perspective, how does this discussion of kind of the banks sort of essentially like digging these moats around themselves to charge for this financial data? What are your thoughts on this?
Yeah, so look, JP Morgan came out recently saying they wanted to charge the fintech ecosystem, I think $300 million for access to consumer data. And it was done under the auspices of, consumer protection and their own kind of cost structure to support this information. I think it's really just hiding the true intention, which is sort of an anti-competitive move, right? Ultimately, Plaid, which again, in full transparency, I helped seed the company back in 2013. Andreessen, we're, large investors in the business. So, I have a strong point of view here, but Plaid ultimately sits at the intersection between the bank, a fintech application, and the end customer, right? And so they do play this sort of intermediated role. But ultimately, I think it's who owns this information, right? JP Morgan has a strong point of view that they own the information. I believe that consumers own their own data, and that we need more open kind of standards, for how people are able to share their own information with other, third-party applications. The analogy that I use often is, do you own the photos in your iPhone, or does Apple, right? Should Apple be able to charge Instagram for you authenticating access to your photos? I don't think so, right? I think you ultimately you should be able to share your photos with any application that you want to connect to. And JP Morgan is basically saying, no, your photos are mine. And we're going to be able to charge their Instagram equivalent $300 million for access to your information. I just don't think that's fair. And I think it's veiled under this sort of threat of, consumer protection and their own cost structure. The reality is, data infrastructure costs have come down so precipitously, and we're talking about your account and routing number, right, and your transaction history. It's really not that sort of technology intensive. And for many, banks, they don't actually have real-time APIs, right? And so for the long tail of community and regional banks, I think Plaid plays an even more important role in becoming this sort of like data utility and enabling kind of this ecosystem of fintech companies to build interesting applications on top of those products.
Aside from Plaid, are you seeing investing opportunities that kind of capture that theme of perhaps consumers getting their rights to whether it be data, finances, or maybe even iPhone photos back?
It's an interesting question. I mean, there's a lot happening kind of in consumer fintech broadly, and I think AI is sort of changing the conversation here in a lot of ways. Maybe it's a different answer to your question, but my partner Alex recently announced an investment in a company called Salient, which has launched voice agents for auto loan servicing, right? And what's interesting in this capacity is, these are large non-bank and bank auto lenders that have, very large, armies of call center folks now using voice agents who can speak in, 50 languages, 24/7, fully compliantly, in many of these markets. And so I think it's an interesting question of how is sort of technology and the software actually doing the work, and how is that changing the relationship with, with the end customer. And so that's, I think, one of the bigger themes that we're seeing in consumer finance. There's a lot happening also in the back office, in many of these bigger financial institutions.
I want to talk a little bit about, it's funny, you don't necessarily think of venture capital and politics until like the 2024 election. And I think Andreessen Horowitz really finds itself at the center of the political ecosystem right now. Mark's very close with the Trump administration. He's advised President Trump. He's been outspoken with his support. The firm hired Daniel Petty after his acquittal. I think people would say that's political there. Andreessen Horowitz's very first hire, Scott Cooper, now a month into his gig as HR chief for the federal government. We had some reporting recently on the Bloomberg terminal, Riley Griffin, noting that Scott was introduced to Commerce Secretary by Mark and Ben. What is, they have this connection to or relationship with the Trump administration. How do you feel about that in the sense of like having a direct line to the administration or a direct line to Washington, given Andreessen Horowitz's involvement in this administration?
Look, I think from a macro perspective, 15 years ago, technology was sort of this industry that existed, only in Silicon Valley. It was sort of not part of the conversation in DC. It wasn't really a conversation in most industries. Mark, famously wrote this essay, Software is Eating the World. I think that's happened, right? Technology is now proliferated across every industry, in our society, in our economy, and as a result, is directly impacted by, DC and the regulatory environment. And so I think their point of view is it's really not partisan. I know that there's a lot of headlines that have happened, from the presidential election, but fundamentally, I think our view is we want to support what we call the little tech agenda. We want to, back on both sides of the aisle, people who support innovation and support sort of technology's advancement. So we've donated to Democrats and Republicans in support of this issue.
Well, do you feel like you have a more direct line now than you did during the Biden administration?
Certainly, I think as a firm, we've taken a much more front-leaning approach. I think Mark and Ben and others at the firm tried to spend a lot more time, in the prior administration. I think that was part of what governed their, decision to be more vocal, in this presidential election. I think it's important in general to have a dialogue with DC, because again, I think technology is just, permeated every part of society, and you have the largest technology companies with massive lobbying arms in DC. There is sort of this tragedy, the commons challenge in the startup ecosystem and in the venture ecosystem, because it's highly fragmented, right? These are relatively small institutions, and so I think their belief is, if not us, then whom? And so I think we're trying to be sort of a convening force and creating a voice for this tech ecosystem, again, to drive innovation and ultimately, I think, better outcomes for society, for the economy, et cetera.
We're speaking with David Haber, general partner at the venture capital firm Andreessen Horowitz.
And, David, I have another question for you. I cover consumer finance here at Bloomberg, and, we did just see the Chime IPO. We've seen a number of sort of consumer-facing fintechs do quite well in the last couple of years, and kind of there are these sort of household names, frankly, that you and I use for a lot of corners of our financial lives. Robinhood comes to mind as well. Yep. But, I guess I'm curious, is consumer fintech dead? Are we kind of shifting to a lot of these, we mentioned a few names earlier of kind of infrastructure companies, financial services infrastructure companies, where it's still fintech for sure, but it's not like fintech that you and I would know the name of or see the brand in. We might see their ads on the subways, but we don't interact with them. What are your thoughts?
Yeah, look, I think part of it is just how the market has evolved, right? When many of these companies started in 2012, early 2010s, many of the largest banks didn't have mobile banking products, right? Many of them weren't acquiring customers online. And so it was much easier, candidly, to launch with the Wedge product, to spend money and acquire customers and build, a much larger user base. I think the challenge, over the past several years is CAC is the new rent, right? A lot of that spending has now gone to the largest technology platforms to help, these big institutions acquire their end customer. And it's just become a lot more competitive. It's much more difficult, I think, to break through and compete now directly with a Robinhood or a Chime or a SoFi, et cetera. It's one of the reasons. I think there are other reasons culturally within these financial institutions. Their willingness to leverage third-party technology has changed dramatically in the last 5 or 6 years. And as a result, made it much more interesting to back software-led companies and infrastructure companies selling into these institutions to, again, solve real problems, change their workflows. And I think that part of the kind of more B2B side of the market has become more interesting, at least to me.
David, we only have 30 seconds left. What is the most interesting company that you've made an investment in that our audience hasn't yet heard of that should be on their radar?
Oh, there's a bunch, but it's hard to pick. Paige wrote a great article on a company called Moment that is building fixed income trading infrastructure. And so, again, kind of a wonky part of the world, but if you're a wealth management client, getting a bond ladder is still a manual process today at most large financial institutions. Soon that will be done programmatically. I think this is a company, albeit more infrastructure, that's going to become much more well-known over time.
You're a man who knows his audience. We can talk about bond ladders and bond infrastructure all day here on Bloomberg. David Haber, general partner at the venture capital firm Andreessen Horowitz. Also with us, Paige Smith. She is consumer finance reporter for Bloomberg News. This is Bloomberg Businessweek Daily.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all declining right now. A slide in tech stocks pushing key U.S. indexes toward their fourth straight day of declines as investors question sky-high valuations. Also, minutes ago, top of the hour, we did hear from the FOMC. We got the minutes, and most Federal Reserve officials highlighted the risk to inflation as outweighing concerns over the labor market at their last meeting last month as tariffs fueled a growing divide within the central bank's rate-setting committee. Right now, we do have the S&P 500 index trading lower, as I mentioned, down for a fourth day. Right now, we got the S&P down 30. That is a drop of 0.5%. Dow Industrials down 40, a decline of 0.1%. The NASDAQ Composite Index down 221 for NASDAQ, a drop right now of 1%. Our Mag 7 index lower by 1.5%. Among some of the names in that index, we do have Apple down now by 1.9%. Tesla shares, they're down by 2.3%. The 10-year yield, 4.28%, with a 2-year, 3.73%. Spot gold up $29 the ounce, up 0.9%. And West Texas Intermediate crude oil up 1.4%, $63.21 a barrel. Bitcoin right now just about flat on the day, up $50 per token, 113,605 on Bitcoin. Earnings news, Estee Lauder issuing a weak profit outlook for its fiscal year, dragged down in part by tariff costs. Again, recapping here, stocks lower, S&P down 0.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Do appreciate it. Well, earlier today, Oaktree Capital Management co-chair Howard Marks spoke exclusively with John Farrow and Lisa Abramowitz on Bloomberg Surveillance. They covered a lot of ground in the interview. He said stocks are expensive, though there's no reason to think a correction is coming. Here's what he said when asked about the state of investing in the U.S. and if the environment here has deteriorated.
Is the United States still the focal point for defensive investments?
I think I said in the memo that I think the U.S. is still the best place in the world to invest. The things that make the U.S. exceptional, the spirit of innovation, the free markets, the rule of law, the capital markets, the growth and dynamism, the great companies, these things are still all true. But as I said in the memo, we're the best place. We may be a little less best than we used to be. The world is thinking that maybe the U.S. is a little less best than it used to be. And I can't argue against that. I mean, fundamentally, as an investment environment, I think things are a little bit deteriorated.
Is there a place where you see has more opportunities right now just based on valuations and based on maybe a firming up of contract law and other aspects that really lead to a robust investment backdrop?
Well, as I say, I still think we're the best place in the world to invest. We're a great car at a high price. You can get some cars around the world that are not as great as ours, cheaper. Which do you prefer? Less good at a cheaper price, or better at a more expensive price? Other parts of the world do not have our dynamism. Lots of places in the world are overregulated compared to the United States. But if they're on sale relative to the U.S., it's not unreasonable to want to have some representation there.
Well, there you have it. Just part of the interview with Oaktree Capital Management co-chair Howard Marks speaking exclusively with John Farrow and Lisa Abramowitz earlier today on Bloomberg Surveillance. Emily, as I mentioned, they covered a lot of ground. In addition to that, he was asked about the idea of whether or not stocks are in a bubble right now because of values. And he said, in the early days of a bubble, though the critical point for a correction has yet to come. I heard the interview. I was struck. He said it was like maybe 1997, I believe, is what this reminds him of.
Yeah, he actually put in his recent memo that January 2nd of this year was the 25th anniversary of his memo, bubble.com. So he's well versed in financial history and reading this. It's interesting. He also said that he flew to South America on a plane without Wi-Fi. So he didn't have email or entertainment. So what did he do? He wrote this memo about valuations and potential bubbles here, of course, before coming on Bloomberg TV.
Yeah, amazing what you can actually get done when you don't have the distractions of modern technology. Well, in other news today, speaking of modern technology, Google introducing the newest additions to its portfolio of Pixel devices. Bloomberg Technology co-host Caroline Hyde is at the event in Brooklyn. She's standing by with Google's Senior Vice President of Platforms and Devices, Rick Osterloh, fresh off his keynote address at Made by Google 2025. Caroline, take it away.
Tim, thank you. There were quite a number of celebrities alongside Rick Osterloh. I mean, just an array of fabulous people coming on to talk about the latest hardware. But for me, the takeaway was the AI, was Gemini just interweaved between everything. Is this the showcase? Is this why you have hardware, to just show off what Gemini can do?
Yeah, I think that's a big part of it. I mean, Gemini is a huge part of Google's strategy. We've made so much progress with it. We've got the best models around. We have the best AI assistant. We're just so excited about what we've talked about today. And yeah. I personally love using the VO video model. You saw a video of my dog talking in the show, which was really fun to put together.
A cute poodle across something.
Yeah, he's a Portuguese water dog who somehow speaks English. But it was really, really fun to put that together. And this is kind of the power of AI now. You can do things for fun, you can be a lot more productive with it, and Gemini is the thing that powers it all for us.
I mean, Steph Curry's doing things with sports. You had Alex Cooper there, Call Her Daddy, doing things with camera. I'm interested, though, how this sets you apart. What are you offering, do you think, versus the competition? How am I going to be able to use it in a wholly different way than currently I could with a competitive out there?
Yeah, well, I mean, I think AI in general just transforms all of these products. Yeah. On the phone, it's going to make it so much easier to interoperate with your phone. You just talk to the AI and it'll do things for you. You can show your camera to the AI and it'll give you hints about what to do, like if you're trying to do a project at home, like fix some plumbing or fix some shelves, whatever it is, AI can help. And we're really excited about our partnership with Stephen Curry to apply this AI technology to personal coaching. And, you know, I can't think of a better person to work with than him. He has sleep coaches, nutrition coaches, fitness coaches, and he wanted to work with us to bring this kind of capability for personal coaching to everyone. And so that's what that partnership's all about. We're really excited to work with Steph.
And in many ways, you were helping oversee the purchase of Fitbit back in the day. It's now in the form factor of a watch that you've got on. Rick, though, what form factors are we yet to see? We've got the pods in your ears, you've got the watch, you've got the phones.
Right.
Where next?
I think there might be a few coming next. Well, we're bringing Gemini to a bunch of surfaces you use every day, but they'll probably be used very differently, like automotive. There'll be Gemini in your car, on your television, in your smart speakers and smart displays. But I think a really exciting thing that'll come in the future is Gemini in glasses. So we're working on smart glasses that'll run Gemini as the main way you interact.
Any sort of year that you think that'll be coming out? Is this going to be
it'll be
Brooklyn
coming out
2027?
Sometime next year. Will be pretty exciting to see.
2026. I'm interested in how the vertical integration so helps. Look, you've got the Tensor G5, the new chip. What does that bring in terms of the effectiveness?
Yeah, well, I mean, a big focus of Tensor all along has been on trying to run AI. And, you know, we're trying to show what AI on devices can do for the whole Android ecosystem. And we're making an example with Tensor, but also working with all of our other silicon partners like MediaTek and Qualcomm and others. And what we're trying to do is run the Gemini Nano model and do things like Magic Queue that you saw today.
Yeah. Talk us through that for the audience.
Yeah, I mean, Magic Queue just allows a user to be able to quickly process something from another application when they're in the context of say, like your Messages app. So, for instance, there were examples shown of pulling up reservations for a restaurant and just having automatically a little button that says call the restaurant when you're in a text thread with a
Jimmy
friend.
Fallon helping show that one.
Jimmy Fallon was very good at showing that. but it's just an example of trying to make things easier for the user and help you be more productive. And it's using AI to kind of make these connections across applications.
What I love that you said at the start of that answer was about the Android ecosystem.
Yes.
And I think, guide the audience for us for a minute. Why have this hardware? Is it to be in and of itself profitable? Is it to be showing off what Android can do? Is it more about just the impact that you're going to be able to have with partnerships as well under this?
Yeah, I mean, it's a little bit of all those things, but certainly a key thing is to be able to show off our software so that everyone can see what it's possible of doing. And so, you know, we found it to be the best way to get our Gemini AI capabilities out through Android, through our partners. And with Pixel, we can show the best that it can do. So we're very excited about that combination.
I mean, the world of technology is a beautiful one of frenemies. And you've got the partner, but also the competitor that is Samsung. How does that evolve in this AI ecosystem?
Well, I mean, we work very closely with Samsung. We work together with them on Gemini technology as well. We're really excited about the launches they just did with Fold 7 and Flip 7, showcasing some amazing capabilities and some great hardware. And that's sort of the benefit of Android, is it's an open ecosystem where a lot of people can participate. They can show what their brand can do, and we're just so happy that they're able to take advantage of Gemini too.
Bloomberg Intelligence analysts are always so great at sort of helping tell the story of the entire vertical nature of Google. Mandeep Singh was on the show a little bit earlier, and he was really interested in ultimately how you're going to use sort of the chip locally within Gemini as well. How does that give you an edge?
Yeah, I mean, it can be very helpful to be able to process things on the device, either for speed of operation or perhaps when you're in and out of network coverage. And also, of course, it can help keep things private too. You know, if there's something very sensitive and you just process it on the device, it just stays there locally and you don't have to worry about it. But, you know, all these things are just part of a whole picture of AI, and we're just excited to be able to have this whole stack, this full stack that allows the users to do so much with Gemini.
And it's a global offering, but already, what is it, next week I'm going to be able to buy the phone.
Yes, that's right.
But maybe a bit later for the watch. Is there a supply chain issue here? What is putting us back in terms of manufacturing?
No, it's just sort of normal operations. We have sometimes staggered releases, and the watch is just coming out a little bit later this year.
Has everything been beautifully seamless when it comes to supply chain? We always know that's a headache.
It's always tricky. It's always difficult managing a supply chain, but these products are coming off very well.
And more broadly, is the measurability of success here the number of sales, the profitability of the business, or more how everyone goes off and starts adopting Gemini more broadly?
Yeah, I mean, it is probably the last thing you said is the most important thing. We want to showcase what Gemini can do for everyone and then get it distributed as broadly as we can. I mean, Google's mission is to try to serve everyone, and Pixel is one way we do that. But of course, there's so many other ways. We offer Gemini through all of our partnerships. We offer Gemini through the web. We offer Gemini in so many ways. And so this is one way that we can get it to market through Pixel.
Well, it's about the platform as well as the devices, and that's exactly your title,
right.
Of course, Google SVP of Platform and Devices. Rick Osterloh, it's been a joy speaking with you. Thank you very much. Have a great rest of your day, and back to you in the studio.
Thanks so much. A big thank you, too, to Caroline Hyde, standing by with Rick Osterloh, Google's Senior Vice President of Platforms and Devices. They are doing that in Brooklyn, fresh off his keynote address, Made by Google 2025. Shares of Google, by the way, Alphabet, I should say, today down by close to 1 percentage point, but we're seeing tech slide a little bit. Taking a look at the markets right now, the NASDAQ Composite down 0.9%, the S&P 500 down about 0.4%. I'm Tim Stenovec, along with Emily Graffeo. Let's take a look at some stocks on the move today. With us is Bloomberg News' Vildana Hajric. Vildana, what do you have on your radar?
I have a slate of retail companies that I'm looking at that are really in the news today, and I chose them because they all have sort of personal relevance, maybe if not just to me, but to all of us.
Okay.
One is TJ Maxx, that's ticker TJX, up about 3.4% today after the off-price retailer boosted its earnings per share forecast for the full year. I personally love the TJ Maxx brands. I'm a huge fan of Marshalls. I think a lot of people are, and you can see that, you know, customers who maybe are growing really worried about inflation and tariff-related issues, that they actually have been shopping at TJ Maxx and Marshalls and some of their other brands, as we know that they are offering things at a discount.
Maybe they're pivoting away from some other higher-end retailers.
What's the personal connection to this one?
Are we talking about Target?
I was trying to segue into Target.
I want to know, but no, the personal connection to TJX.
Oh, I said I love Marshalls.
Oh, okay.
Yeah,
Thank you. I missed that.
I'm like...
Sometimes you have to say it twice for me.
Oh, okay. Should I say it a third time for you? I love Marshalls. I think it's the best store. It's so fun. You'll spend so much money there on stuff you absolutely do not need, but absolutely love.
Okay.
Yeah, I'm not a spokesperson, by the way.
What about for Target?
Target. Ticker TGT, down some 6%. The retailer is picking an internal CEO appointment, which is the news of that is sort of offsetting better than expected second quarter results. And it did maintain its guidance, but still shares are lower today because of that news about the CEO.
And he'll join Target's board, this new CEO, while the current CEO, Brian Cornell, who has led the big box retailer since 2014, will transition to focus on his role as executive chair. It's always kind of disappointing for the company, for the person, you know, assuming the role when you see the shares fall as much as they do when there's like a leadership change.
Well, it's been a really tough road for Cornell. There have been a lot of issues, not just with the company's sales, but also culturally and sort of looking for the identity in this new political environment. But yeah, anytime you see executive shift or executive changeover in a stock response like this, I think it creates a challenge.
Opposite happened to Starbucks, right?
Yeah.
When Chipotle's CEO,
Brian Niccol.
When he went over to I think it rose 25% that day or something along those lines.
Okay, finally, Estee Lauder.
Estee Lauder, another retailer. Again, I know I said, something that might be near and dear to a lot of people's hearts, maybe to yours, Tim, I'm not sure, but shares are off by 5% today. It said it hired external advisors to conduct a review of its brands, of the brands that it owns, and they're really looking to accelerate a turnaround after years of sales declines. Obviously, they carry a number of different brands, world-renowned name, and for those who are not in the know, it's skincare, it's cosmetics, it's hair care, it's fragrances. So shares off by 5%.
And it's fancy skincare. One of their brands is La Mer, which infamously has a moisturizer that goes for $390.
Yeah.
Tim, if you're looped in to the luxury skincare lore.
I will say they do own Le Labo, which is what my wife really likes. So. Yeah.
Fragrance. That's a fragrance brand. Yeah. Mm-hmm.
Okay,
that's
so
right.
I know it.
Yeah, I knew you would.
Yeah,
that's why
near and dear to my heart too.
Yes, exactly.
Yeah, it took me a while to find that though.
Oh, okay.
That's Vildana Hajric. She is a Bloomberg News cross-asset reporter. For more conversations like this, check out our new Stock Movers podcast. You can subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Check out Stock Movers on Apple, Spotify, or anywhere you get your podcasts. Taking a little bit of a turn lower for tech stocks, the NASDAQ composite down a little over 1% right now. The S&P 500 down just about half a percentage point. Taking a look at the industry groups, consumer discretionary to the downside of 1.3%, IT down 1.3%, communication services down 0.7%. Well, that is going to do it for Bloomberg Businessweek Daily on Bloomberg TV. If you're sticking around on TV, the close is up next. Coming up next, though, on Bloomberg Businessweek Daily, on radio, YouTube, and Bloomberg Originals, we got a great program coming up. Todd Gillespie is going to be joining us in just a minute. His story among the most read on the Bloomberg terminal after Citigroup hiring a law firm to investigate complaints about the behavior of the bank's wealth management chief. Also, Bloomberg exclusive, Lauren Grush, who reports on space, will be joining us about recent struggles at SpaceX. All that and more coming up next on Bloomberg Businessweek Daily. This is Bloomberg.